Okay, good afternoon, ladies and gentlemen. It is my pleasure to introduce Dr. Salvatore, our speaker today, and he will be talking about growth stagnation after global financial crisis. Dr. Salvatore is a distinguished professor of economics and director of PhD program in economics at Bloomsburg University, New York City. He's an honorary professor at a few universities in the United States and also in China, in Italy, and some other countries. And he's a fellow of the New York Academy of Science and past chairman of the economic section. He's also past president of the North American Economic and Finance Association and the International Trade Finance Association. He is consultant to the United Nations, World Bank, and IMF, and several major international corporations and global banks around the world. He's the co-editor of the Journal Policy and Modeling and the Open Economic Review, the associate editor of American Economics and Frontier in Finance and Economy, and the past editor of the handbook series in economy. Some of his book has translated in 15 languages. So he has given over 500 lectures around the world and was awarded the Achievement Award by the City University of New York in 1997 and was nominated for 2010 National Medal of the Science awarded by the President of the United States. Please join me and welcome Dr. Salvatore for the campus. Thank you for coming.
Thank you, Professor Irvian. It is a pleasure to be here. Every couple of years I travel the 200 miles from New York to come here, and it's a pleasure. The topic, growth or stagnation after the global financial crisis. Maybe you should have a question mark there, but we will see. What I will examine is first who predicted this crisis, and then the causes of the crisis in the US and contagion, how did it spread to Europe and emerging markets, and then the weakness of the US economy, crisis in the Eurozone. I just came back yesterday from Europe, and if we think we have problems, they have bigger problems. And then when will this crisis be over and growth resume? Now the first part is, first of all, we know that the crisis that started in the middle of 2007 and in which we still are in, is the first global financial crisis of the 21st century. It is the deepest and really the first global one. But now, why would it have been useful to predict the crisis? As we know, the purpose of theory is to generalize, explain, predict. Now, if we could have predicted this crisis, we could have run for cover. We could have done expansionary monetary policy. We could have lowered interest rates, increased investments and the GDP. We could have done expansionary fiscal policy. We've done it after, but if we had anticipated it earlier, we could have anticipated it and perhaps made the crisis less deep. But we did not. Now, there is someone, Muriel Rubini, who goes around the world, for those of you in the field, saying that he predicted the crisis. And he gets huge honoraria for doing so, because supposedly he predicted the crisis. I say, Muriel Rubini, you predicted nothing. The reason is, in order to make a prediction which is useful, you need to specify the timing and the reason. You have to tell me when the crisis comes and why. You cannot say we are going to have a crisis. Just a day follows night. We are always going to have crises. You have to tell me when and why. And if you make a mistake on either one of them, you predicted nothing. So I said, Rubini said, in 2004, that the crisis was imminent. And my dictionary, imminent means not necessarily today or next week, but it means within a month or 2 months. And you said in 2004 that the crisis would come because the dollar would collapse. A crisis which was possible then, and it is possible now. But it is not the crisis that came. Then in 2006, you repeated that a crisis was imminent, again imminent, 2 years later. And now the crisis would come from the primary commodities increasing in price very, very much, very quickly and very rapid, very high. And that didn't come. Then in 2007, you got up and you said today in Bloomsburg is cloudy. When everybody knows it's cloudy, perfect prediction. Now if I were to say this crisis will be over without saying when or how, I have said nothing. I mean, it's a perfect prediction, but I did not say anything. So you always have people roaming around saying that they have done so. In 2002, the U.S. had another recession in 2001. Krugman in 2002 said, we are going to have double-digit recession right away, which didn't come. Then in 2003, he repeated that it would be a new double-digit recession again, which didn't come. I mean, I said, well, at this rate, he's bound to be right one of these days. I said, not only that, he stated that we would have a crisis for sure. He said he must have a direct connection with God, which common mortals do not have, because the crisis did not come. And I knew it didn't come, and I don't say it now, I said it then, because in 2002, 2003, we did not have high growth. However, labor productivity was continuing to rise. That meant the real economy was in good shape. We had excesses in the financial sector, which needed correction, but it was not really a problem, and that's why a recession would not come. So you have a lot of people who now go around saying they have predicted what they have not predicted. We wish, but no one is a crystal ball, and neither does Krugman, nor does Rubini. Now, what do we need? What do we need to have correct forecasts, or at least useful? We cannot always be right, but if we have a correct analysis, then it can be useful, even though we may miss the turning points of recession. First of all, we need a broad knowledge of theory. Theory is like a GPS. It tells us where to go, what to do, what to expect. Now, professors often, we hope, they know the theory, but very often they do not know the real world. Business economists know the real world, but they've forgotten or never learned the theory. Then you have those few who have the theory and the real world knowledge, and they are pessimists. You need a little common sense. The pessimist in my dictionary is a person who always predicts crises. And when the crisis doesn't come, instead of being happy to be wrong, they are even more unhappy because they thrive on crisis. So now you need theory, you need knowledge of the real world, and you need a little common sense. And this is often what's lacking. So that's why we have a problem. That's why we would not predicted the crisis. But now, why did the crisis come? Now, it's not we want to look forward, but since the causes of the crisis are still with us, we can say there were inadequate financial regulations. As you know, the banking sector has two parts. There is the commercial banking sector, who's the poor cousin. They live on collecting deposits, giving loans. They make very little profits. And then there is the investment banking. Those are the rich cousins. That's where the money was. Now, we had adequate regulations in the commercial banking sector, but that's not where the crisis came. It came from the investment sector, which was not adequately regulated. Not only we did not have adequate regulation in the financial, in the investment banking sector, where the crisis originated and continued, but also the regulations that existed, we did not apply properly. I mean, the Security and Exchange Commission was supposed to regulate. And if you remember, or those who have seen the head of the Security and Exchange Commission testifying in front of Congress, he looked completely inept. He was out of it. He was asleep at the wheel, as the sort of say. Then there was greed. Now, greed is not illegal. It's unethical. In other words, something may be legal and unethical, so profit at all costs. They did not necessarily do the wrong thing because we did not have the adequate regulation, but certainly they had profits at all costs, greed. And that was another reason for the crisis. And finally, fraud. Now, you can have adequate regulations, you have laws, but there is still fraud committed, and that can cause a crisis. Now, Madoff, you remember, made $65 billion disappear. Now, a month ago, I was in Serbia, a country of 8 million people, and the GDP of Serbia was 44 billion. Madoff, by himself, made $65 billion disappear. He made a Serbia and a half disappear. I mean, that is incredible. So we had the causes really were inadequate regulations. The regulations that we had were not actually applied. There was greed, which was not illegal, but profits at all costs, and fraud. We got into a crisis also because of fraud. They go to jail, but still we have a crisis. Now, I go to Europe all the time, and they say, you see what you created? The U.S. So, wait a minute. The crisis originated here. We take full responsibility. But if you had not committed even more excesses that the United States committed, you would not have had the crisis come to Europe very quickly, because the financial sector moves very quickly, and deeper. And the proof is that your banks committed even more excesses than American banks. That's why it came to you quickly and deeper. Look at how do we measure risk? We measure it by leverage. Leverage goes from zero, an index from 0 to 100. If you have zero leverage, it means you are not a bank. You have a safe deposit. You have all the money that people deposit there, always available to be withdrawn, and you have zero risk from going out of business. If you have an index or leverage of 100, for sure you will go out of business. So the higher the leverage, the higher the risk. Lehman Brothers, when it went out of business, its leverage was 31, from 0 to 100. Citigroup, the largest U.S. bank in trouble, was 38. But UBS, of which I'm a consultant, Swiss, the leverage was 42. Deutsche Bank used to say that its leverage was 25. I said, how do you measure it? They only measured risk in the commercial banking sector. No, my friend, that's where the risk comes on the other side. It's 56, and Barclays 63. The weighted average leverage of the 12 largest U.S. banks was 20. For Europe, it was 35. So your banks were committed more excesses. You undertook more risks than U.S. banks. That's why you suffered this. And we know in the financial sector, as I said, everything moves at the click of a mouse. So it moved very quickly. The other aspect, or the other cause of our crisis, actually originated in the housing sector. So you had a bubble. And look at the bubble. Now, it's difficult to see in the back, but if you see, this is 1997, and this is the long-run trend in housing prices. The long-run trend is slightly rising. It doesn't mean that housing prices have to continue to move that way. But that's Ireland. This is the UK, housing prices. This is Spain, and this is the US. In other words, from 1997, look at housing prices in Ireland. Look at the UK. Look at Spain. Look at the US. We had the bad housing problem, but Europe had the bigger housing problem. So when the crisis came, it came quickly because of the financial sector and deeper in Europe. So you, Europe, you not deserve, we feel bad of the suffering, but you committed even more excesses. Yes, the start came from us, but if you had not committed those excesses, you would not have done as in a crisis, or not as deep. And this is the growth. And this is what happened. The U.S. In 2009, real GDP in the U.S. went down by 3.5. That's a deep recession. Okay? And in 2010, when we came out supposedly of the recession, growth was 3%, which did not even recuperate the loss of 2009. Now, these are the latest projections of the IMF and World Bank, but very likely, those values will be even lower. So they are perhaps too high. So this is nothing to write home about. After the recession in 1981-82, which was the deepest before this recession, real GDP in the U.S. for 6 quarters after the recession grew at an average of 7.5% per year. Now we are talking about 1.5, 1.8. But look at Europe. Europe, the recession was even deeper, and Germany, that was supposed to be the motor, the growth engine of Europe, the same. It went even further down. They grew faster than us, but did not even recuperate. And look at Japan, that was supposed to conquer the world. Up to 1990, Japan was supposed to be what we think of China today. And look at Japan. So this is how the crisis came, and it came deeper in Europe. And now then spread to emerging markets. They did not this time commit any excess, but they were now really affected by what happened in advanced countries. But it happened in the real sector, which does not move as rapidly as the financial sector. So I came with a lag of 6 months or 1 year. And where did it come from? Well, the blue line is the growth of real GDP. The growth of real GDP in the first quarter of 2009, the depth of the recession, real GDP of the world declined by about 2%. But the brown line is the decline in trade. This is the decline in trade, 9%. Since our imports and the imports of advanced countries come to a large extent from emerging markets, when advanced countries went into recession, they began to import much, much less from emerging markets, and the recession in advanced countries spread also to emerging markets. But we will see in what way. This is one way through the real sector, and that's why it came with a lag. The other aspect, or the other avenue through which the emerging markets got affected was when advanced countries got into a recession, they began to have less investments in emerging markets. And this is what happened. These are the investments of advanced countries in emerging markets. This is 2006, $300 billion. This is 2007, okay, this was an unusual year, $700 billion, but then it went down to 200. So from 300 to 200, advanced countries in recession began to invest less in emerging markets. And so now the crisis spread, not because of their own excesses, but because it was true contagion to emerging markets. And this is the way it came. Now, notice China was growing at 10.5 and went down to 9.5, and then maybe down to 9. We are amazed by China's growth because no country grew on a consistent basis at this rate for many years. China's been growing more or less at this rate for 10, 20 years. Now, I know China well. I'm a professor at the University of Shanghai and Peking University, even though the city now is called Beijing, the university is Peking. Peking University, they consider the Harvard of China. And I've been going, everyone goes to China now, but I've been going to China since 1986, and the leading text in China in international economics and managerial economics are my texts. So I know China. But people say they just speak for themselves. They don't. A growth rate of 10% is amazing, but put in the proper perspective and interpreted correctly, this is like 4% rate of growth in the U.S. The reason is China still has about 400 to 500 million people still living in subsistence agriculture. they need at least 5-6 percentage points of growth in order to absorb those people. So 10%, amazing as it is, and indeed it is amazing, it is like 4% growth for the US. We have to interpret it properly. Then we have India. Now India used to grow fast when agriculture did well, 5-6%, but when agriculture did badly, they grew 2-3%. Now India found a way to grow rapidly, and frankly, we are delighted. Otherwise, we would have to say that China, which opened up economically, but frankly, it is still a dictatorship, okay, grew, and India, the largest democracy of the world, did not grow. It was embarrassing. You know, we were distraught. It's almost like you cannot be a democracy and grow. Now India found its way to grow rapidly, and we are most delighted. Russia says we grow fast. Well, you know, Russia as democratic as I'm an Eskimo. Okay, I mean, if it weren't for the exports of raw material, primary commodities, gas, petroleum, they probably would grow 2-3% per year. So, Brazil, Lula used to go around and says, look how fast we are growing. Never mind the 7.5%. The average for 4 years is 3-4%. Now, 3-4% for Brazil, it's like 1% for the US. Brazil is the country of the future. When is the future coming? We wish them well, but 3% growth is not, it's, as I said, 1%. So we hope now they found its way. Also, I am a consultant to the Reserve Bank, or the Central Bank of South Africa, and the primary consultant to the government. And President Zuma said, I want an independent central bank. However, I told the central banker who studied with me to reduce rates by 2 points, 2%. He reduced it by 1, so I fired him. So well, that's very independent, you know. I mean, you know. And then I said, well, since we are at it, you promulgated that you want to increase the income or the wages of everyone in South Africa by 15% because there's a great deal of poverty. That's very commendable. But we wish it was so simple. I mean, if it was simple by a signature that we increase wages 15%, then we can increase it 50%. We know if we don't increase productivity, it will only increase costs, it will reduce international competitiveness, and in fact, we grow less, not faster. So we, you know, emerging markets are emerging. They did not create excesses. However, they are not as growing as rapidly as they could, maybe except China and India, but they could do better. They have a greater potential. But what did we do when the crisis came? Well, these are the interest rate, monetary policy. Look at how immediately interest rates were lowered when we realized that when all advanced countries realized that we were facing a deep recession, we ran for cover. We lowered interest rate drastically. The only exception was Trichet, the governor of the Central Bank of Europe, who actually in June 2008 increased interest rate, thinking that the problem of Europe was inflation, and thinking aloud that Europe would avoid the crisis. I mean, we don't want to criticize him after, but he was the only one who thought that Europe would not be going into a crisis. Europe was already in a crisis. But look how we lowered. England lowered its interest rate to 0.5%, the lowest interest rate since the establishment of the Central Bank of England in 1694. So we ran for cover. We lowered interest rate. Japan is practically zero. We have a quarter. England has half. Europe has 1. So we did all of the monetary policy that we needed. And this is 2001 for the UK, the US, and Japan. Japan is a flat line at 0. This is the US, a quarter, 1%. This is the UK. And this is what Trichet did, the governor of Europe. In April 2011, he increased rates. And in July, he increased rates again. I mean, we don't want to criticize, maybe he knew what we did not know, but he should have known what we knew. And, obviously this was a completely wrong policy, and we do not say it afterwards, we said it then. And so now he was supposed to lower rates immediately, but he would have, if he did, he would have admitted that he made a terrible mistake. But anyway, so not only we lowered interest rates, we increased liquidity. We inundated the market with liquidity. In other words, the Fed put on the market liquidity more. In other words, you can borrow at very low rates. On top of it, we make loans available, even at those low rates, very much available. And this is 2008. Look what happened to the liquidity, how much we injected into the system, the Fed. But the saying, it's like for those in economics, we are in a liquidity trap. We can bring the horse to the water by making loans available at low rates, but you cannot force the horse to drink. Businesses do not borrow, even though it's available, if they do not expect the economy to grow. So we've done everything we could from the point of view of monetary policy, once we recognized the crisis and the depth of the crisis that had come. And then we've done fiscal policy. Now, fiscal policy means we spend more and we take in less. So the budget deficit increases. The bigger the budget deficit, the stronger the fiscal policy. And look at the US. Well, never mind Greece, but even look at the US. The US had budget deficits of 10%, 11%, and then for 2011, 9%. This is bad. In Europe, there was the Maastricht criteria that no country could have a deficit more than 3%. And even 3%, you see, you're supposed to have a surplus when the economy does well, and then have a deficit when the economy is not doing well, so you stimulate the economy. But even 3% is based on the assumption that we grow at 3% per year. So that if the deficit stays at 3%, the same as the growth rate, the total debt doesn't change, and it remains sustainable. We are unsustainable. We have become as outrageous in our expenditures as many of the countries that we used to laugh at, you know. In other words, we are as bad as many of the other countries and worse than some. Now, it's true that we should have a deficit when we have a recession to overcome it. But these deficits are structured deficits. It's very difficult for us to reduce them. And we have a debt. A national debt which 2 years ago was 60% of GDP. Now it reached 100%. So we have a problem. We cannot do any more fiscal policy. We already did excessive fiscal policy because we are spending much more than is sustainable. Okay? People say, well, if we didn't spend that, the recession would have been even deeper. Yes, but we cannot continue to spend this. And it's not because we're in a recession. It seems like we have reached a point where we don't want to reduce, rightly so. We don't want to reduce health expenditures. We don't want to reduce education. We don't want to reduce military. We don't want to reduce anything, but we are living beyond our capability. So something has to give. And these are the debt that we were discussing. Now look at the U.S. It was 93, the U.S. debt, but we are getting, now it's over 100. And those on the right are the deficits. Any deficit over 2-3% is not sustainable. You can run a deficit higher maybe for a year or two, but now it seems we have been running it for 3-4 years, and even, as I said, this year is 9%, far above what we... So we've done monetary policy as strong as possibly we could. We've done fiscal policy more than we could, and we are still in serious problems. This is the rate of unemployment. The bars, you cannot see well, those are the years of recession. Now we had unemployment which was higher than now, 10.8, during the recession of 1980, 81, 82. That's when it was 10.8, but now it was above 10, now it's 9.1. They are very high rates of unemployment. And in all frankness, those rates would be even higher if the way we count. You see, each year, each month, the American economy, you have each month about 120,000 new workers coming into the economy. So we have to provide at least 120,000 jobs in order not to have the rate of unemployment increase. Well, since the end of in the past 2 years, we created less than 100,000 jobs per month. So not only we lost from 6 to 8 million during the recession from the middle of 2007 to the middle of 2009, but we are not even creating enough jobs to absorb the new entrants into the labor force. So that number should be higher. Why is it not higher? It is the way we measure it. If you are looking for a job and you stop looking because you get discouraged by not finding it, suddenly you are not counted any longer as unemployed. So if we counted all the discouraged people who no longer seek a job but are unemployed, and those people who work part-time, who would like to work full-time, the rate of unemployment would be a shockingly high of 16.5%. And that's the real rate. But we can see, even though you cannot see from the back, what these numbers show you is how much unemployment increased during previous recessions, and how far from the end of the recession, how much employment has come back. For example, these are the previous recessions. Okay, this is the recession 2000-2001. We lost 3% unemployment. 2% unemployment, okay? Between the beginning of the recession and the depth of the recession, we lost 2% of employment. So the rate of unemployment increased by 2 percentage points. And then after 48 months, 4 years, we went back to the same level of unemployment. This is the recession now. Instead of losing 2 percentage points of unemployment, and 3% of unemployment during the 1980 recession, we lost over 6%. And 42 months after the end of the beginning of the recession, look at how much we are. We still have 5 percentage points more unemployment than we should have. In other words, instead of having 4% rate of unemployment, we have 9% of unemployment 42 months after the beginning of the recession. We are in trouble. We are not creating enough jobs, and it's different from the depth is more than twice as much, and after this many months, in the past, we went back to the same rate of unemployment. Now, we are 5 percentage points of less unemployment. So, we are in deep troubles, and this is really affecting the U.S. economy. That optimism, things will get better. People are beginning to lose that optimism, which is what distinguishes the U.S. economy from Europe economy. We don't want to be like Europe. This is a country of dynamics. This is the country of the future. And in Europe, they're dead in the water. But we are beginning to become more and more like Europe, and that is very much problematic. This is the official rate in the U.S. and Europe, but as I said, that rate doesn't tell us very much. This is the stock market. People in finance know that we should receive higher rates for investing in stocks than in bonds. Bonds are safer. Stocks are less safe. The more the risk, the higher the return. The return in the past 5 years, it was 12,100 in November 10, 5 years ago, and it is 12,154 5 years later. This is the first 5 years, or the first decade, where bonds did a little better than stocks. Stocks are more risky. They should give us a higher return than bonds. Instead, we have the same level. So the stock is, and this is the stock market in the U.S. and Europe. Europe does worse than the U.S., but doesn't help us to be a little better. This is since 2005. We are lower today than 2005. So now the reasons. Why is growth so slow? Why there is a danger of double-dip recession? There are various reasons. One is unsustainable budget deficits. In other words, we cannot borrow anymore. The markets will refuse investors to buy U.S. bonds if we continue to run these deficits. Look what happened in Europe. In Europe, when the debt becomes too high, investors don't invest anymore, the rate of interest increases, and the whole thing becomes unsustainable. So now we have already unsustainable budget deficits and government debt. We cannot spend more to get out of the recession. You see, Obama would like to have another stimulus package. And Republicans say, if you do not reduce the future trend of expenditures and deficits, the markets will react and will end up like Europe. So now we need both. We may need the stimulus package, but we cannot have a stimulus package unless we reduce the long-run trend of unsustainable expenditures in the future. So the Democrats don't move, the Republicans will move, and we dead in the water. But we cannot do much. You see, we need maybe a more stimulus, but we cannot have a more stimulus unless that trend of expenditures is lowered. But we cannot agree on how to lower it, and so then we have economic uncertainties. You see, for a person who's never been in a business, he or she does not know. The worst thing you can do to a business person is uncertainty. Businesses today do not know what will be the tax rate next year. They do not know what will be the expenditures, health expenditures next year. And so now they stop. They do not move. And whatever policies is 1 year. The horizon of a business person is 5, 10 years. So now they do not know what taxes they will pay, what is the cost of the health care. There are policies being proposed that have a horizon of 1 year. So they sit still. They sit on a pile of cash, they don't invest, they don't create jobs. That's the other reason why we are not growing. Then there is the undervalued Chinese currency. Now, China says, it's not true. But, we have to look at the real, objectively. The Chinese currency is about 20 to 25 undervalued in relation to the U.S. currency. This is the equivalent of China imposing a 25% tariff on their imports from the U.S. and giving a 25% subsidy to their exports to the U.S. Of course, that causes U.S. exports to be lower, to import more rather than produce domestically, and some simulations indicate that if that currency was in equilibrium, more or less, the growth rate of the United States would be about 1% higher. Instead of 1.5%, would be 2.5%. It would not have very much, but it would be almost doubling. So every little thing helps. And then we have outsourcing. Now, outsourcing is good because it allows us to consume, to pay lower prices. But we create no jobs. We create no jobs. So now we are outsourcing, we are buying from abroad cheaper, we offer free trade, but we don't create more jobs. Let's go quickly over these, one after the other. This is the expenditures of the United States, and these are the revenues. Look how wide the spread is now. So we cannot continue. We are already spending too much. We cannot rely on spending more to grow faster. Economic uncertainties. We discussed uncertainties on tax rates and health costs. Too short policy horizon, firms do not invest. And this is what the exchange rate of the dollar with the Chinese currency, this is what it should be. So it is lower than it should be. The Chinese currency is undervalued in relation to the U.S. dollar. People say, that's our business. No, my friend, it takes two to tango. The exchange rate is not what you decide because it's a relationship between two prices. And if you don't feel that it is undervalued, let it float. and find its own equilibrium. If it will be floating, it will reach equilibrium. It will reach equilibrium, and the Chinese got. Now, to be sure, we cannot blame China for our problems. China is allowing its currency to gradually appreciate. And with prices rising faster in China, the real exchange rate is appreciating. So in 3 or 4 years, it should reach equilibrium. But it's not there yet. And these are the trade deficits of the United States with China. These are the monthly deficits. And this is the proportion with China. In other words, this is the monthly deficit of the United States, of which this part is with China. Now, there is no rule. No rules. I still have the leading tax rate international in the world. I tell Paul Krugman, he's wonderful. There are a few things I can do better. And that's, there is no rule that postulates that we should have equilibrium in the balance of payments bilaterally. But when one country is responsible for 55% of the trade deficit of the U.S., something is unbalanced. Again, we don't want to blame China for our problems. These are primarily our problems, but they contribute. They are corrected, but it's taking time. In the meantime, we suffer. And then we have outsourcing, we said. Cheaper goods, but no domestic production in China. President Obama said we should innovate more. Yes. But we don't create jobs. Who created the iPad? The U.S. In 6 months, 25 million iPads were produced. Not one in the United States. So how are we going to create jobs? Now, we want an open system, but somehow firms have to look that when they give production outside, we will lose our ability to innovate. In other words, we first produce and innovate. Then we innovate and give production out. But once production is out, we will lose our ability to innovate, and at this rate, we cannot innovate anything. We innovate, and we don't create jobs. Somehow, firms must look to not just the bottom line now, look at the bottom line in 5 years. If you teach everything to everyone else, then they will take they already took our breakfast, they are taking our lunch, and they'll take our dinner. Technology is our property. Our property. You cannot steal it, you cannot copy it without paying royalties. Okay? So, and technology. Look what happened to GM. Again, we don't want to blame China. China does its interest. We have to do our own. GM produced the Volt, the best electric car in the world. It spent $10 billion to produce it. And now China says, we will not allow you to export the Volt unless you teach us from A to Z on how to make the Volt. And GM says, well, if I don't allow it, they will import from Japan. If I allow it, they will copy it, and in 2 or 3 years, they'll take over my market. That's where government policy comes in. If I were in government, I would say, you GM, you cannot sell or you cannot give away what is not yours. We bailed you out, the U.S., by giving you $45 billion. Without that $45 billion, you would have been out of business. Out of the $10 billion that you spent to create the Volt, 6 or 7 billion comes from taxpayers. You cannot give out what is not yours. At the same time, we can get GM out of the hook by going to the World Trade Organization and say, according to the rules, no country, in order to allow me to export something, can demand and me having to give the technology. This is stealing. So now, the U.S., this is not trade war or anything, and nor do we want to blame China. China does its interest. So now we go to the World Trade Organization and say, no country can stop us from exporting anything without giving them the technology. This is our property. And that would solve the problem. It seems easy, but GM then will not give. China has to allow the Volt to be exported. Okay? But obviously, people in government, I always say, if I'm wrong, tell me I learned something. If you have no better way and you cannot, why don't you do it? Why don't you do it? Now, we don't have much time for the Eurozone, but we have the Eurozone has had unsustainable budget deficits, even more than the United States, and the periphery of the Eurozone is living beyond its means. if you are a train conductor in Greece, you earn tax-free $10,000 a month, and the year has 13 months. And if you wash your hands before going to work, you earn an extra $500 a month. And if you go to work on time, you earn another $750 per month. And you can include traveling to work as part of work time. And the day off is 28 hours, not 24 hours. I mean, so now they rebel because they used to live far beyond their means, and now they cannot continue that way. People don't realize that. They're used to what they got, but what they got, they were living beyond their means. So they spend too much, and now they're used to it. So government changes, they go to demonstrate. But if I were in government, says, no, until now, you've been spending twice as much as you can afford. Okay? Now, what do you want? The previous governments cheated you, made you feel that you were richer than you are. Now, the real world is here. Tell me how else to resolve the problem. But they're in for 10 years of problem. Well, this is a special... these are the interest rates on government debt before the creation of the euro. These are the weak countries that were paying much higher rates for their debt before the creation of the euro. When the euro was created, all the interest rates on government bonds of all the countries of the euro became the same. In other words, the market began to feel that since there was this common currency and a common central bank, a debt from Portugal, Spain, Italy, Greece was equivalent to a debt of Germany, a government bond of Germany. And so now the interest rate went down, they borrowed even more, but then Lehman Brothers and the crisis started, and now the interest rates on government debt of the weak European countries shut up, and so now they borrowed more because the interest rate was low. Now the interest rate is high, even the debt that they had before is no longer sustainable, so now they have to cut expenses, cut the government, do the equivalent of contractionary fiscal policy in the face of deep recession. So that is a serious problem. This is labor costs. Look at unit labor cost. This is the year 2000, and this is Germany. In 10 years, German unit labor cost increased 5%. The labor cost of Greece, Portugal, Spain, Italy increased by 30%. So now they cannot borrow as much because interest rate rose, and it's not sustainable anymore to borrow or continue to borrow. They have to reduce borrowing, and they cannot export because they have a common currency, and now you have to compete on costs. You see, what we teach in economics is that you can buy a wage increase by productivity. If your labor productivity increases by 5% per year, it means you can increase wages by 5% per year without increasing unit labor costs. But if you increase wages without any increase in productivity, all of the increase in wage is an increase in labor cost. You lose international competitiveness, you lose production, and you are in trouble. So now they are in deep trouble these days, and there is even a possibility, not very likely, but the chances increase, that even the entire experiment of the euro may collapse. I don't think it will, but they do not realize how much sacrifices must be paid. The Germans have to pay now for the Greek debt and other people's debt. And they say, well, this is not fair. But they think they're going to pay for 1 year or 2 years. They will have to pay for 5, 10 years before things get back to normal. If they don't, the whole experiment will collapse. But frankly, it's the Germans also don't think they did not get their benefit. If there were no euro, the Deutschmark would have appreciated much more than the euro, and their exports would not have grown as much. Also, they are helping Greece because they suddenly realized, France and Germany, that the debt of Greece and the other country is held by German and French banks. So if they collapse In fact, the Greek debt is worth 50%. In other words, if you bought a Greek bond of $100, it's worth $50 now. Now, if that is factored in, the major French and German banks would be collapsing. So now they are helping because they know that they're helping their own banks. And their own banks gave these loans because they knew that eventually maybe a problem would arise. But they also knew that their government, French and Germany, would not allow large German and French banks to collapse. So they got the high interest by giving loans, even though they knew these countries could not repay. And then when they could not repay, their government would chip in to prevent them from going out of business. Profits are private, losses are public. So that's why now they want to give help. So now, when will the growth resume? We saw that terrible graph of unemployment. We lost 6 percentage points of unemployment. We lost from 6 to 8 million jobs during the recession, and we are creating fewer jobs than each month number of entrants into the labor force. And until the election, probably nothing will happen. We are dead in the water. And as I said, what we need is, yes, Obama is right, we may need a new stimulus package, but that stimulus package by itself, if it is not done at the same time reducing the trend of long-term unsustainable expenditures, even the stimulus package will fail, because the markets will realize that we are uncontrolled, we are spending. So now what would be necessary? First is to see exactly what the tax rates will be next year. How much is the cost of the health care? Lower the tax on foreign profits so that they can repatriate and invest at home. But nothing, and we need more infrastructure. We are falling behind in infrastructure in relation to Europe, Japan, and other countries. So, but nothing is happening. And probably until the election, not much will happen. And this is much, much longer, much, much deeper than any experience we had as a country since World War II. In Europe, when will the crisis end? When Europe will have a common fiscal policy. In other words, you see, I wrote an article in the American Economic Review in May 1997 saying then what the problem would be. The problem is, if the Northeast of the United States were in a recession, asymmetrically from the rest of the country, the Northeast cannot do fiscal policy because most states must balance their budgets each year. They cannot do monetary policy because the Fed does it for the entire country. They cannot do exchange rate policy because it's not determined for the Northeast. It's for the country as a whole, and it's the market. So now, the Northeast cannot do anything if it were in recession asymmetrically from the rest of the country. They cannot do expansionary fiscal policy. They cannot do expansionary monetary policy. They cannot do exchange rate policy. But in the United States, we have a great deal of migration. People will leave the Northeast to other parts of the countries which are not in recession. In Europe, labor mobility is 1/4 of that of the United States. So there is no escape hatch for a country like Greece, which is in deep recession. Also, we have fiscal redistribution in the United States. The unemployment insurance is not paid by the state, but by the federal government. In Europe, there is no fiscal redistribution. The federal budget, or the European budget, is 1.5% of GDP, most of it spent on agriculture, subsidizing agriculture. So now we can have a single currency. A state in recession doesn't have to do monetary, fiscal, or exchange rate policy and still have some way of overcoming the problem. In Europe, a nation in recession cannot do any of those. They do not migrate easily. They cannot have fiscal redistribution. They have to suffer 5-10 years of tightening their belt. And that is what Europe is facing. Emerging markets will continue to grow, but not as fast as it would if the rich countries would do well. So the purveyor of bad news usually is lynched. I'm not the purveyor of bad news, I'm positive, but we need to do something, and I do not think that much can happen for another year on this. Thank you very much.